Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, welcome to the Smart Property Investment Show. It's Phil Tarrant here. I'm the editor of Smart Property Investment. I'm also the host of the podcast. Thanks for tuning in. Appreciate you listening in to us, hopefully with the purpose of trying to increase your knowledge around investing and becoming a better investor. So that's what we try and do. It's how we try and help out. And today's podcast is very much geared towards covering off some of those key issues that our listeners are having. And we offer the opportunity at the end of every podcast to write in to ask us questions if it's about the smart property investment portfolio or just investing in property in general. So we like doing these podcasts. We try and do them sort of every couple of months or so. We get a lot more questions than what we do have time to answer them. So if we haven't responded to you at all, we do apologise. We'll try and get there eventually. But today we've chosen 3 questions that we've had in from our listeners to try and tick off. And I've asked 2 people to join me to help me out with this. So I've got Tim Neary in the studio. He's the editor of a sister brand to Smart Property Investments, real estate business. How you going, Tim?
Good, Phil. Thanks for having me on the show. Love the show. Thanks again.
Good one, mate. So Tim looks after one of our big brands here at Momentum Media, which looks after residential sales agents called Real Estate Business. So very popular. Includes the top 100 agents, which shows the best agents in Australia. We've also got Todd Hunter in the studio from the Ware Group. Todd, how you going, mate?
Yeah, good. Good. Thanks for having me.
Yeah, people sort of wrote in saying that they didn't mind you on the podcast last time around answering questions. So we thought we'd invite you back.
Thanks. So the audience invited me back, not you?
Not me. Go and watch, mate. I'll just want one little error and you're gone. You're punted. I'll get someone in here who knows what they're talking about.
I got the Reader's Choice Award, have I?
Yeah. Baby. So Todd's a buyer's agent who's based in Sydney but buys right across Australia. If you ask him where he's buying, and I do it every single time I see him, he tells me to get stuffed. So have you got anything for us at all? Anything at all?
Oh, we spoke about a year ago, and I did say Canberra was the place to be, and now you're just watching all the growth come through on Canberra right now, and it's there's still a few deals down there.
So you're not out of Canberra yet?
I'm not out of Canberra, no.
Okay.
So I'll give you that. I'm still in there. We've bought lots down there, and still continuing as much as we can. It's I think it's a really good opportunity. I think the incomes are great down there, and there's a lot of things happening.
What are you picking up? What sort of assets down there? Just all and sundry, or is there anything that you're really looking at? Come on, give me something.
I've got 2 locations down there. So one area is a lot of them are sort of 3-bed, 1-bath renovated homes.
Okay.
So and the other area is sort of more your new sort of 2008 sort of built homes that are sort of a 3-bed, 1-bath or 3-bed, 2-bath style.
So we're talking like the secondary market of these. So people bought them
Correct.
new, and these are the guys who are upsizing probably or downsizing and then moving
Either
on.
that or just selling their investment properties.
Okay.
Yeah. So
you don't really know if you're buying off investors or owner occupied.
I'll buy off both.
Off both.
Yeah.
Doesn't really matter.
No, I just buy where I can get a good deal.
And what's a good deal down in Canberra mean?
Most of these properties we're under the 420, 430 mark, so sub that. So That's good. The effects of what they did in Gungahlin with all the townhouses and units that went through a few years ago, and there was a high vacancy rate in the ACT, is all gone now. The vacancy rates are really low, and the yields have come back very strong. So it's very promising.
So these are all late 90s, are they, or early 2000 builds? Did you say?
In one area, they're sort of the 2006, 2008,
Yep.
and other location they're probably the early 90s, but been renovated. So nice new kitchens, bathrooms, etc. in them there.
And we're not doing what we said we'd do, but I'm quite interested in this. So if you're buying up in Brizzy and stuff, there's
Sounds like he's got me.
Yeah. No, this is a generic question.
Yeah.
But like if you're buying up in Brizzy, there's some major things you see in all houses of a particular vintage. You got to keep an eye out for pests and stuff, or some of the build issues that you have up there. Is there anything in particular in Canberra that you need to watch out for? Like, is the level of construction when they were built, these properties late 90s or into the sort of 2008, 2009, by and large, were they reasonably well built, or is there any sort of fundamental problems that you need to really look at? Like, is there big pest issues at all? Or
No, there's not. You don't tend to find the termite issues are anywhere near as bad because of the colder weather. The construction's fine. There's no issues there, but you do need to watch the pre-88 built homes, which is when a company called Mr. Fluffy was around.
Yep.
And and they do have free inspection programs. And Mr. Fluffy was the infill insulation for your home. And the issue was that pre-88, then it was there was asbestos. If that company did it, there was asbestos infill. So And they've already demolished, I believe it's about 1,000 homes in the ACT, which the government bought back at market level. and which was nice. It put pressure because then there was 1,000 homes or 1,000
Not in the
families
market.
that had to go out and get another home. So that was good, but there will be still more that are out there that haven't been found yet. So you don't probably want to go that pre-88.
Good, mate. That's
Good
really
advice.
good. Thanks for that.
Cool.
Yeah, all right. He's not going to tell me off air, so don't worry. I don't know. But, you know, Todd's a good buyer's agent, and you find that... I think last time we had you on the show, we had a bit of a poker analogy, and I'll use one right now, that Todd keeps his cards very close to his chest. Anyway, let's move on. Our first question is from Letitia Towers, and Letitia has written into us, loves the podcast, so thank you, appreciate that. Letitia's 42, has 8 properties. She bought her first one at 19 years old after starting to save my pocket money from the age of 4 to air quotes buy a house. So always been a passionate property investor, it looks like, Letitia. My question is, when is it time to stop buying? I currently have an LVR of 57%, so that's a loan to value ratio of 57%, so that's a debt against the value of her portfolio, and no servicing issues, means she can afford to pay it with plenty of dollars left over every month. But I'm looking at the fact that my daughter will have to handle all these assets when I'm not here. And is that fair to put that onto the kids? Appreciate your thoughts. Well, I reckon your kid's a pretty lucky person.
Absolutely. and the LVR 57 is very, very neat. It's nice. It's where you want to be and below. I think that sub 60 mark, when you get a good portfolio, is you do not want to be over 60% once you start to build, sort of 8 or anywhere bigger than that.
So if she doesn't do anything from now, so from here she goes, I don't want to buy anything else, and she's 42, still young, got another 25 years left of work in her, she didn't want to retire, what would happen to that LVR over the next 20 years?
Oh, it would continue to go down, but the other thing is the yields or the rents would continue to increase, and if she continued to work out paying that debt down, you would find that maybe at that stage that there would either be no debt or very, very little debt, and Letitia, I wouldn't worry about handing the burden over to the children, because I think it'd be very most welcome for them to get that.
Yeah, it's a nice generational asset. So how can you pay down debt on a investment property loan, Todd?
You can either have an offset account, which you can build the money up against an offset account, or you can just physically put the money straight onto the loan. So through your work or self-employed, and any excess on the rent that comes in, you can continue to keep putting that onto the loan to reducing the balance.
So a lot of people get interest-only loans. So at a point in time when you are building an investment property and you want to start thinking about what is my out, one of the outs, or the out is you want that portfolio to be unencumbered with any debt. So the ways you can do that is to pay down the principal of the loan. So it's not interest only, you pay down the principal, which means you need to switch to a principal and interest only loan at some point in time.
No, you don't need to. No, you can leave it as interest only and still put the money onto the loan. It just means that you're contractually only obliged to make the interest repayments. But if you had another $100 a week and want to put that onto the principal, you're more than welcome to do so.
And that would reduce the capital?
That would reduce the capital or the balance, yeah.
So if you're 5 years interest only, and if you just pay down the principal component of it, so you're only paying interest on what's left, at a point in time you'll need to get another loan once that 5 years expires. So would that be a point in time when, if your plan was to drive down the principal of the loan, is that when you would convert to a P&I?
If you're comfortable in those repayments and those numbers are there, then most definitely. Or maybe you may not have to refinance if you're still on competitive interest rates. You may just stay with that lender and it'll just convert back to principal and interest. So, and if it's comfortable, then just continue that on.
So if you have a redraw facility associated with a loan, that means if you need that cash, you can pull the principal back out?
Yes.
Is that correct?
Yeah.
Okay. The other thing to do is have an offset. So you offset the principal component of your loan with cash that you have sitting in an adjacent account. So if you have a $200,000 interest-only loan and you have $200,000 in an offset account, essentially you're going to pay $0 interest on it. If you put that money into the principal, it's a lot harder to take that out unless you have a redraw facility. But if you keep the money in an offset, it means that you're liquid. So if you need that cash at any point in time, for whatever reason you've got it, or if you choose to start buying property again, you've got the cash.
Correct.
Okay.
Yeah.
So the question here is, when is enough, pretty much? So there's ways in which, if you want to, Letitia, pass on this property investment portfolio unencumbered to your children, which isn't a bad thing, you need to start driving that down. What it comes to, whether or not you should keep buying or whether you should start doing it, is going to completely depend on what you want to achieve.
I think she's answered her own question for the whole reason that she's asking when's enough. I think enough now. It's like, if you're questioning, do I need to buy any more, you've actually got a nice income coming in per month that you could continue that in reducing that debt to increase that income. 8 properties is ample if they're unencumbered to retire on, and the children can take over. You really don't need a portfolio any bigger than that.
And that, you said, that's a good sweet spot as well. That 57% LVR. Is the 60%? Is that the mark that you like to look for?
I like to be at that level. I like to be sort of in my own portfolio sits at about 55, 56 at the moment.
Right.
And that's where I'm very comfortable at it, and I want to continue that down. In my own investing plan, with my portfolio, I will have to sell some of my properties to pay off existing investment debt, but what looks like here from Letitia that she may not have to do that if she continues to keep working for the next 20 years. I think that you'd be very close if not have those properties paid off.
I think she's in good shape.
Yeah, it is. It's
very good shape.
One of the people ask me all the time why I invest in property. There's a number of reasons why I do it. It's great to be able to talk about it on the podcast and smartpropertyinvestment.com.au, but that's not the primary reason, but it's a really nice byproduct. Obviously, want to create wealth through property, and people go, what does that mean? And I think for me, property investment is that it allows you to have a choice at some point in time. So if I choose to be retired, I can be. If I choose to want to keep working and doing what I want to do, it allows me to have that choice. So I think Letitia's in a situation where a portfolio, 57%, 8 properties, you're going to have probably some reasonable equity in that portfolio. Now, if that allows you to have a choice to spend more time with your kids and stop working as much, that's a good thing. But it all comes down to what you're trying to achieve. And for a lot of people, it's about spending more time with loved ones. And if property allows you to do that, brilliant. If you can pass it on and they can have a better life, great as well.
It'll get at a point over the next 20 years that, those properties will need a little uplift and, some new carpet or a new oven and things like that. So there'll be a little bit of upkeep with those properties. But as long as you keep them nice and the rents will increase, I think the 8 that you've got's enough.
Stop if you want to stop, keep going if you want to go. Only you can really sort that out, Letitia. But, so you speak to an accountant if you want to do some planning around what you require for retirement. If there's a big number that you need or want to live comfortably or live the life that you want to live, they could probably give you some guidance in how to establish what those goals are. But it pretty much comes down to you, and you got to run those numbers and work out what you want in life. Let's move on. Pete Sharman. Pete writes in to us, loves the podcast, good. I'm about to start my property portfolio and I'm keen to find a good buyer's agent. Can you recommend any good ones? Well, we've got a buyer's agent on the show today.
A buyer's agent, yeah.
A buyer's agent on the show. I like giving you a hard time, Todd. But that's probably a good question. So I'm very pro buyer's agent. I think as part of let's call it an A team that I have built in my property portfolio, have a very good accountant, mortgage broker, have a very good buyer's agent. And I also have a lot of other people who are in property, who I talk to property a lot about, who I wouldn't call them mentors at all, but I'd call them people who have a like-minded interest in property and are willing to share that information. And you're one of them, Todd. It's good just to shoot the shit about property. It's good. It expands your horizon and knowledge. But when it comes to buyer's agents, my comment around this would be a good buyer's agent is worth their weight in gold. A not so good buyer's agent often is money just thrown away. So you need to understand what a buyer's agent does. Todd, what's a buyer's agent do?
Buyer's agent is a representative for you to be able to purchase a property in its most simplest form. But what a buyer's agent should be doing is getting you into key investing locations at your dollar figure that you can afford, and getting you into a really cheap ground level price. So you can create wealth.
Actually, what, Phil, a little earlier when we were talking about Canberra, and Todd was talking about his experience down there, that was a really good example of what a buyer's agent does. You were just was talking through it, you weren't thinking about it, you weren't selling it. But anybody listening to that would have just got real good insights into...
Yeah, don't buy properties that were built before this period of time because they're going to have asbestos, they're going to have a lot of problems.
All of that stuff, all of that inside knowledge, absolutely.
It's the inside running. To me, there's a couple of things a good buyer's agent does, and they give you an inside running. So a lot of the places we've bought, and probably you're the same with your portfolio, Todd, never even hit the open market.
Yeah.
You get a phone call from a real estate agent who goes, I've got to shift this really quickly. It's a mortgage in possession, or there's been a death, or there's been divorce. We need to shift it now. It's this much money. A good buyer's agent will go, immediately, that's X number of thousands of dollars under market value. I'll have that property, thanks. And then go through the process of doing some due diligence. Buyer's agents get those phone calls. Your typical punter, unless they're doing a lot, investor, don't get those phone calls. So they just give you the inside running. They know what a place is worth based on the market because they're in the market all the time. They
make a decision instantaneously.
Yeah,
so
they know the difference between one street compared to the next street because of this historic work that they've done in those areas. So there's a lot of buyer's agents does. They can do all that sort of stuff in terms of helping you identify where you should be buying based on your goals, but also they can help you through the whole process of negotiating for property as well. So making sure that it's always good to have a representative on your side, I think, when it's negotiating. You're not connected emotionally. They can help you establish a price point to which you should be bidding up to at an auction, or if you're buying through private treaty, and just be your advocate to do that. And in my experience, good buyers agents typically get you the property a lot cheaper than what you do it yourself, and you don't have to spend days and days and days doing it. So that's what a good buyer's agent should be doing for you, plus some other stuff. And you should check out smartpropertyinvestment.com.au, and we've written a lot about this, checklists on how to find a good buyer's agent. But look, you can go alone, but if you want to go alone, you've got to be ready to do a shitload of work in order to be able to find the right property that's going to meet your needs. So a lot of very good investors are completely hands-on and do the whole process themselves, but it's going to come down to your bandwidth, your appetite, your view on advice as well. And you know what? Todd is a good buyer's agent receiving a kickback from a developer.
Yeah, no.
So you need to understand how buyer's agents get paid as well.
Yeah.
And your point was they are your advocate. So if you're shopping for a buyer's agent, make sure you actually know how they're getting paid, and it should be a fee for service. So you should be paying them a fee to help you do what you want to do. They shouldn't be receiving any type of fee from any agent or any other third party.
Yeah, no, 100% agree.
So I hope that helps, Pete. Go to the site. Read a whole bunch of stuff. And if you want to contact us, editor at smartpropertyinvestment.com.au. We're going to finish this podcast with our last question, and it's from Len. I don't know Len's last name, but Len's another big listener to the podcast and reader of smartpropertyinvestment.com.au. He's asked me details around my broker, accountant, buyer's agent, etc. I think we just covered off how to choose people like that. But one of Len's key points here is around insurance, Todd. So another grey area for me is a type of insurance that I should have in place for each investment property. Can you help me out with this? Also mention who my insurance provider is, things to pay attention to when comparing insurance coverage would be helpful. Okay, what sort of insurance do you need on an investment property?
Well, you need, if it's a house, you need house insurance, but you also need contents, which a lot of people completely miss, because they think contents is the lounge and the bed, and it's actually not. It's the contents actually comes down to ovens, stoves, hot water systems, light switches, curtains, carpets, things like that. So you definitely need contents. Landlord protection insurance is paramount. So and they don't have to be together. So your landlord protection insurance can be with one firm, and your house and contents can be with another firm. So and a big thing that we do every year, what I do for my own portfolio, is a ring around. Depending on what tragedies have struck around the country, depending on what insurance companies have been affected by, and for instance, if there was a cyclone in Cairns for some reason and one insurance company was heavily affected up there, then you're going to find that their premiums across the whole country are going to be affected. And if you're in part of that insurance firm, well, then you're going to be affected. So once a year, I like to do a ring round, and it's time consuming, but I do it, and just to make sure that my policies are the best and the sharpest in price. And if they're not, we move.
So do you haggle with the insurers as well and say?
You do. Once you have a few properties, you can certainly haggle. Yeah, most definitely.
So how many different insurers do you use for your portfolio?
Only two.
Okay, who are they? Don't know.
You know what? It's probably more of a bet question. For
Okay.
me. So
see, that's a really important point. It's just.
well, we're in it together, so that's that's her part of the equation.
I know, but it's largely irrelevant who the provider is, as long as you know that your properties are correctly insured and that the price is competitive. Doesn't really matter too much.
She's probably going to laugh when she hears this, but because I don't know who they are, but I know that she takes care of it for me.
It's also another really good thing about sharing the responsibilities of a property portfolio.
Yeah.
You can't do everything. Well, once you get to a portfolio which is quite sizable, you've got to start choosing where you can add the most value. And there's a couple of different components of running a portfolio, and that is the administration of it and trying to get some cost savings, but also growing it and building it. Imagine your time is best spent on finding the next gem within the Canberra market.
And then I allow her to do more put the files together for the accountant, which
all the really interesting stuff.
And she curses at me every year. So
nice point that you make, Todd, as well, though, that you don't have to bundle the insurances together and understand properly what is contents, and don't overlook stuff, because that could be a cost. Yeah.
You also need to understand, if you're buying properties which are apartments or units, that the strata is responsible for components of the insurance as well.
Yeah. So
make sure you educate yourself around that. And typically the strata, not always, but typically the strata will cover sort of building orientated stuff. So, if it falls down or, the roof gets ripped off in a major storm, they'll cover as part of your strata fees the building insurance. However, the content is your responsibility. But what you'll find, and you need to make sure you check the fine print with all your policies, particularly with the one that your strata has, that I hear it all the time, that tenants are in bun fights with their strata around whose responsibility it is to pay for certain stuff. And that can be a bit of a headache. So
get that squared away.
Get it squared
one
away.
Day away.
Sorted out. Yeah, nice one. All right, run out of time. I'm getting a thumbs up from Adam, our producer here. I think he's happy with that. We've kept it pretty short. Yeah, got a wink. Todd, thanks, mate.
Thank you.
Appreciate
Thanks
you coming
on board.
Yeah, good. Tim?
Thanks, mate.
Good to see you again.
Thank you.
Remember to tune into smartpropertyinvestment.com.au. We're on all the social stuff, Twitter, Facebook, LinkedIn. You can follow me at Twitter on Philip Tarrant if you want to see what I'm up to. Remember to write into us, editor@smartpropertyinvestment.com.au. And please keep the reviews coming on iTunes. 5 stars are the best, but all we need, guys, is you just keep rating the podcast. If you like it, the more you do it, the more popular it becomes, and therefore the more people we can help out in terms of joining this community around property investing and hopefully making everyone a better property investor, which is what our goal is. So really appreciate your participation, and get involved. If you want any questions or you want to have a chat with me, get in touch, and we'll make sure we either get you on the show or get back to you. So thanks for tuning in. We'll see you next week. Bye-bye.